After the 1949 devaluation, Britain maintained a fixed official rate of $2.80 for £1. Under the Bretton Woods system, a fixed rate was meant to provide stability for trade and payments. But stability at the quoted price required the authorities to keep buyers willing to hold pounds at that price. A fixed exchange rate is a promise about conversion. If firms, banks, and governments want dollars instead of pounds, the central bank needs foreign currency reserves or outside credit to meet that demand. The official price can therefore look stable even while the pressure to change it is building underneath. The House of Commons Library identifies weaker British competitiveness as a long-term cause of the 1967 crisis. When a country struggles to sell enough abroad while buying heavily from abroad, its external accounts come under strain. That does not mechanically require devaluation, but it makes a rigid exchange rate harder to defend. Once holders suspect a devaluation, keeping pounds becomes less attractive. A holder who can exchange pounds before a cut avoids receiving fewer dollars afterward. That logic can turn doubt into selling pressure, making a feared devaluation more likely even before economic fundamentals have changed further. Britain used reserves and international support while trying to preserve the existing parity. The Commons Library notes that the Bank of England was running low on foreign currency reserves and that creditors were becoming less willing to lend without conditions. Support could delay a decision, but it could not permanently resolve a rate that markets viewed as difficult to sustain. In 1967, disappointing trade figures and the disruption following the closure of the Suez Canal added to the pressure on sterling, according to the IMF and the Commons Library. These events were not the whole explanation for the crisis. They mattered because they arrived when confidence and external financing were already fragile. Britain announced the devaluation in November 1967. The pound moved from $2.80 to $2.40, a 14.3% reduction in its dollar value, according to the Bank of England and the IMF. The change did not make Britain richer overnight. It changed the relative price at which British goods, foreign goods, and pound assets were measured in dollars. Sterling was more than Britain's domestic money. It was used internationally and held as a reserve asset. The IMF recorded that within 10 days of the sterling devaluation, 14 other countries changed their currency par values. That reaction shows how a major currency adjustment could transmit through a system of linked fixed rates. A lower exchange rate can make exports cheaper in foreign currency terms and imports more expensive in domestic currency terms. Whether that improves an external balance depends on how buyers and sellers respond and on domestic costs and policy. The 1967 episode is therefore not proof that devaluation is either a cure or a disaster. It is evidence that changing the price cannot erase the underlying choices that created the pressure. For money today, the lesson is about promises that require defense. A fixed exchange rate, a currency peg, or any commitment to exchange one asset for another at a stated price depends on confidence, available liquidity, and the willingness to absorb losses or adjust policy. The visible number can remain unchanged for years while the economic cost of maintaining it rises.